Hello and welcome. Ever wondered how you can pass on your hard-earned assets to your loved ones without them facing a massive tax bill? Well, you're in the right place. Today, we're going to break down exactly how you can gift assets in the UK, protect your family's wealth, and cleverly navigate the world of inheritance tax.
And just so you know, this entire guide has been put together by the absolute experts at ProTax Accountant. They're a top-tier UK accounting firm, and they've helped us create this discussion to give you the clearest, most practical insights possible. All right, let's kick things off with a number that really makes you sit up and pay attention. 40%. Yep, that's the standard inheritance tax rate. It's a pretty stark figure, and it can take a huge bite out of the legacy you want to leave behind for your family.
So that brings us to the big question, doesn't it? How can you make sure more of your wealth goes to your family and less of it goes to the tax man? It might sound like a huge challenge, but I promise you, with the right knowledge and planning, it's a challenge you can definitely win.
Okay, let's dive into this. Here's our game plan for today. First, we'll get to grips with the inheritance tax challenge itself. Then, we'll fill up your personal gifting toolkit with some brilliant tax-free exemptions. After that, we'll master the absolutely crucial 7-year rule, tackle the tricky bits of gifting property and business assets, and finally, I'll show you the common traps to avoid so you can plan your legacy like a pro.
Right, first up, the inheritance tax challenge. Before we can start talking about solutions, we've got to have a really clear picture of what we're up against.
So, inheritance tax, or IHT, is basically a tax on everything you own when you pass away, your property, money, and all your possessions. Now, for the 2025-26 tax year, everyone gets a tax-free threshold of £325,000. This is called the nil rate band. It's the value of your estate over this amount that gets hit with that hefty 40% tax rate. But there's a really important extra bit of good news. That threshold can actually jump up to £500,000 if you pass your main home on to your children or grandchildren.
Now let's look at the next step. This is where we get into the fun stuff, your gifting toolkit. We're talking about the simple but incredibly powerful allowances that you can use every single year. Honestly, think of these as the quick wins for planning your legacy.
Let's break down the tools you have at your disposal every year. First off, you can gift up to £3,000 completely free of IHT. That's your annual exemption. On top of that, there's the small gift exemption, which lets you give up to £250 to as many different people as you want. And get this, there are even special allowances for weddings. Let's imagine Sarah, a freelance designer in London. She could give her nephew £250 for his birthday using that small gift exemption, and then give her sister £3,000 to help her buy a new car. Both of those gifts are immediately 100% outside of her estate for tax purposes. Simple as that.
And here's a fantastic pro tip for you. If you didn't use your full £3,000 allowance last tax year, you can actually carry it forward and use it this year. That means you could potentially give someone £6,000 in one go, completely tax-free. How good is that? But that's not all. Here's where most people go wrong. They completely overlook one of the most powerful exemptions available: gifts made out of your normal income. So if you have surplus income left over after all your usual expenses, you can make regular gifts from it, and they can be immediately exempt from IHT. The catch? The gifts have to be regular. They must come from your income, not your savings, and they can't affect your normal standard of living. Keeping good records is absolutely crucial here to prove that regular pattern.
Okay, let's move on. We've talked about the smaller, regular gifts, but what about when you want to give a larger sum of money? Well, this is where we need to talk about the single most important concept in gifting, the 7-year rule. And stay with me here, the next point might just surprise you.
Any large gift you make to another person is called a potentially exempt transfer, or a PET for short, and the name really says it all. It has the potential to become tax-free. It all hinges on that 7-year rule. So let's go back to our designer, Sarah. Imagine she gives her son £50,000 for a house deposit. As long as she lives for 7 years after making that gift, it becomes fully exempt from ITH. It's completely removed from her estate, and no tax will ever be due on it.
So let's trace the journey of that £50,000 gift. The day it's made is year 0. Now, for the first 3 years, if the worst were to happen and Sarah passed away, that gift would be taxed at the full 40%. But from year 3 through to year 7, a sliding scale called taper relief ticks in, and it gradually reduces the tax rate. And then, once you hit that magic 7-year anniversary, boom, the gift is 100% in the clear.
So what's really interesting here is how this taper relief actually works.
This table shows it perfectly. If death occurs between 3 and 4 years after the gift, the tax rate on it drops from 40% all the way down to 32%. And as you can see, that rate keeps falling each year until, after year 7, it hits 0. This is a really powerful tool that can make a huge difference.
Now, let's look at the next step. It's time to apply all these rules to some of the biggest assets we're ever likely to own, things like property and shares in a business. This is where things can get a little more complex, but we'll break it down.
Right. When you gift a property, inheritance tax isn't the only thing you need to have on your radar. You could also be looking at capital gains tax, or CGT. This is a tax on the increase in the property's value since you acquired it. You do get a tax-free allowance of £3,000 for capital gains, but anything above that is taxed at 18% or 24%. Then there's stamp duty. Now, usually a straight gift is exempt, but if the person you're gifting to also takes over an outstanding mortgage, stamp duty will be charged on the value of that remaining debt. Now, for any of you watching who are business owners or farmers, you need to listen up, because this bit is vital. There are some massive changes coming down the track for two incredibly valuable IHT reliefs, business property relief and agricultural property relief. These new rules are set to kick in from April 2026, so planning ahead is absolutely essential.
And this brilliantly illustrates the big shift that's on its way. At the moment, certain business assets can get 100% relief from IHT, with no upper limit on the value. But from April 2026, that 100% relief is going to be capped at the first £1 million of your business and agricultural assets combined. Anything over that £1 million cap will only get 50% relief. For a business owner like Sarah, if her design agency really takes off, this change could have a huge impact on her estate planning.
Okay, moving into our fifth section, we're going to talk about the common traps people fall into. Because it's one thing knowing the rules, but it's another thing knowing the mistakes that can completely unravel all your careful planning.
Without a doubt, the single biggest trap is something called a gift with reservation of benefit. This is what happens when you give an asset away on paper, but you carry on enjoying the benefits of it yourself. If you do this, HMRC will simply treat the asset as if you never gave it away. It stays firmly in your estate, and that all-important 7-year clock we just talked about, it never even starts ticking.
Let's make this crystal clear with an example. Say you gift your holiday cottage to your daughter. If she takes over full control, she uses it when she wants, she pays all the bills, that's a genuine gift. But if you gift her the cottage and then carry on using it yourself every summer, rent-free, HMRC will see that as a gift with reservation. For tax purposes, it's as if the gift never even happened.
So, how can you avoid this trap, especially with property? The answer is to run it like a proper business arrangement. If you want to keep using a property you've gifted, you must pay the new owner a full commercial market rent. You also need a formal, written agreement in place, and you have to keep detailed records of everything, all the rent payments, valuations, the whole shebang.
Right, we're on the home stretch. Let's pull everything we've discussed together and look at how you can take the next steps to build a really solid plan for your legacy and secure your family's wealth.
So the crucial point is this: be proactive. Make sure you use your annual exemptions every single year. They are the simplest, most effective tool you have. For any larger gifts, get your head around the 7-year rule. If you're a business owner, start planning for those 2026 changes right now. And please, whatever you do, avoid that gift with reservation of benefit trap. At the end of the day, good planning and great record keeping are what it's all about. And that really leaves us with just one final question to think about. Now that you've seen the tools you can use and the traps you need to avoid, what's the one step you're going to take today to start putting your own legacy plan into action?
If you're ready to take that step, the very best way to move forward is with some expert guidance. You can get in touch with the specialists at Pro Tax Accountant for advice that's tailored specifically to you. And just as a final, very important disclaimer, the information we've covered today is for general guidance only. You should never rely on it exclusively to make financial decisions. Before you take any action, you must consult a qualified tax expert like the team at Pro Tax Accountant. Thanks so much for watching.